Dental Corp, which is said to be the largest network of dental practices in Canada, it's been furiously buying up dentists' businesses, has agreed to be acquired by investment funds acquired with an American private equity player, GTCR. The deal is valued at about $2.2 billion. We are joined for more by John Zechner, chairman and founder of Zechner Associates. John, thanks very much for joining us. Yet another company that went public not that long ago being taken off the TSX.
Yeah, it's interesting. You're right. I think Dental Corp went public around $17 or something like that, and then did okay initially. This was sort of in the hype of 2021. Then it went down to a low of 6. Yeah, we actually own it. We bought it down there once it got beaten up. We know Graham Rosenberg, who started the firm, and I like the strategy. It's just a roll-up strategy. I mean, we've seen it in lots of other industries, and it made sense to do in the dental industry where you need a consolidation, lots of players, and they just kept buying the individual practices, rolling them in. I guess giving the dentist the administration and the other support in order to do that. I mean, we've seen that in the veterinary business and other things. So it made a lot of sense. And but yeah, I guess it was cheap at a big discount to similar players elsewhere. And I guess what happened was private equity decided it was worth it, take a shot at, and so they're buying it at $11 a share. So yeah, I'm sure we'll have this one on the sell side this morning. I mean, I'm not greedy. I'll take the 30% plus pop this morning and move on.
Yeah, as you say, a premium to the weighted trading price over the past few weeks. John, how are you feeling about the market generally? The Wall Street Journal points out that there are questions about whether this stupendous investment in AI computing will yield corporate profits in the reasonably near term.
Yeah, I agree, and it's a tough call right now in the market, Andy. I mean, there's certainly you can see some tailwinds. We know that central banks are into an easing mode. Earnings have held up better than expected, and you're right, there is this sort of AI boom. On the other side, I still worry that the tariffs are not fully incorporated in. The trade was a tailwind for the global economy for 40 years, and now it's sort of a headwind given what's going on. And some people think we've seen the worst of it. I don't think so. You had the biggest increase in tariffs in close to 100 years. We're going to see an impact. So you got both sides of the equation. So we haven't really changed our overall stock weighting that much, but I've been sort of actively moving around to more defensive positions and, sort of moving the pieces around on the chessboard and hoping I'm not really just moving the deck chairs around the Titanic.
Journal says people are remembering the dot-com when America was blanketed with fiber optic cable far more before it needed it. I mean, obviously, it eventually got used, but it's reminding us of names such as Global Crossing, WorldCom, and 360 Networks that were among the casualties of that era.
Yeah, you know what, and that's a really good point because you've seen a little bit of the breakdown of some of the sort of higher hype names in the past week or so for the first time in a while. Some of the crypto names and some of the other related where there's less of a valuation support. And I said even sort of crack some holes in some of these, the Oracle story and a few things like that. But the pundits keep saying, no, this is not a repeat of that. I keep hearing that, and you probably hear it day after day. This is not like the late 90s. And I lived through the early 80s, late 90s, all of these things. So we've seen it. And yeah, it's not identical because I will agree that the big tech companies are more robust, they're stronger, they have better cash balances, they're generating positive cash flows. But I tell you, I'm seeing a lot of similarities as well. They really get me worried. And one of them recently, they really started off is almost as this reinvestment that you're seeing back into the existing companies to pump up their sales. And you mentioned WorldCom, these other telecom companies that sort of blew up in the late 90s. And that was the thing. They kept raising money in the market at, 6 times their, PP&E multiple, 6 times. You'd take $100 million and you'd capitalize it at $600 million. So you'd raise that money in the markets, you'd put that money into the ground. Where'd you spend it? On Nortel, Lucent, and Cisco, these other providers. And it was like this virtuous circle till you realize you had, the valuations weren't sustainable. They start to collapse and you've got too much capacity. Now look at what NVIDIA is doing recently. I mean, CoreWeave went public, and what do? They mostly buy products from NVIDIA and then effectively invest back. I mean, you saw that AI deal, $300 billion or 300 Yeah, so this past week, and one of that money just
The
is going to get
OpenAI deal, yeah.
the open IA,
Yeah.
sorry, the open AI, and that'll get recycled where into NVIDIA chips. I mean, yeah, so you see these things continuing. I thought, okay, even with the Intel deal and stuff like that, they're taking money and sort of throwing it back, and then that turns into sales, and that worries me. That is sort of a cycle repeating. So it does, we're getting these froth that we've seen before, and that does worry me. So how does it impact the overall investment strategy? Like I say, I'm moving things around a little bit, not changing my equity weightings dramatically. Definitely more defensive. So we've taken some money out of tech, and we sold some of the big names, and the Amazons, the Alphabet, certainly Oracle, Nvidia. We've reduced all of those names, reduced the tech bet a little bit, shifting into some commodity names. Andy, I sort of like what's going on in that sector, benefiting from the fall in the U.S. dollar, maybe a little more of the resilience of the global economy that we've seen, and certainly China restocking. And it's, it's copper, it's uranium, and certainly we've seen it in oil. So, we added names like Nutrien recently. I think the Canadian rails have been beaten up pretty badly, and, they look like a good buy in here. All the infrastructure companies, Atkins Realis, names like that. So, there's things to move around into, but it's got more of a defensive bias and more industrial focused and consumer focused, and certainly taking that tech weight down a little bit.
You think the worst is over for the Canadian telecom stocks, John?
I do. We've been adding them recently. I mean, they went through this virtuous circle. I mean, they were the big winners early in the pandemic, robust networks. Everybody was home streaming and everything else. And then, that sort of ended. Then you saw a lot of spending. I mean, that's when Rogers went and bought Shaw. CapEx suddenly rose. And then you had the decrease in immigration here, which was key, because that's the only source of new users is, students and all coming in, because otherwise everyone's got a cell phone. You're not really adding more. So ARPU came down. And then Rogers had to get rid of Freedom Mobile effectively, and Quebecor bought it. So you had a stronger fourth player in wireless that turned into a bit of a price war at the same time that they say sub growth is slowing down. So it all, sort of convalesced at once onto the valuations and the stock prices, and they had a miserable couple of years. I think that seems to be ending. I mean, the price discipline is coming back a little bit more. You stabilize on the subscribers. These are still good quality, almost infrastructure assets trading at, 6 times operating cash flow, generating massive free cash flows. Valuations are, at traditionally low levels. And at the same time, you're getting decent dividend yields on all of them. So I like I say, I'm looking for stuff, Andy, where I worry less about the downside and a slow or a downturn in the market, and that there's still some upside and there's some yield, because it's and you keep hearing this. I mean, yourself, Andy, as well. People say high valuations and sentiment alone won't end a bull market. And that's true. The problem is, I think there are a lot of weak hands out there holding. A lot of people came into the game late. A lot of people came in on borrowed money. A lot of people have never seen a downturn. And I think as this market starts to roll over, you might see some panic selling. And you only have to look back to April to see, how quickly that moved to a 20% decline when a slight downturn, because people just panicked. Took basically 7 trading days to have the S&P down over, almost 20% from the peak. And that what worries me a little bit is, the shakiness of that. So that I can't predict a downturn or when it will come, but I think the risk is that it morphs into something maybe larger than, a 3 to 5% pullback.
John, thank you very much indeed. Great having you join us.
Thanks, Andy.
John Zechner, chairman and founder of Zechner